So I'm going to call the meeting to order and stand for the pledge.
Oh, yeah.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
So I have a copy here of the notes from the meeting with the trustees. And I want to just quickly go through that. And then I sent out also the email that I received from Brad, looking for what do we need for liquid right away. But here was the basic, the minutes from or my notes from this. And I sent this to Brad to make sure that he concurred with the minutes. The discussion was about the proposal of the financial advisor to move 15% of the funds into stocks and the remaining 85% fixed income instruments such as short-term treasuries, and to hold cash sufficient to meet expected immediate needs. As Patrick noted, that it has been the current sense of the board to stay in conservative investments to protect principal as the primary objective. But the board was concerned with the stock market risk to the principal. The advisors noted that yes, there's risk in the stock market, but there's also risk in staying very conservative investments, particularly in an era of high inflation. Chair Maxwell noted these funds have not been utilized in several years and there have been very little return on investment. As Patrick asked the advisors why they felt that this was the ideal time to move some money into stocks, which is one of the questions that you had asked at the last meeting.
Yeah. And
noted that at the last finance subcommittee meeting, there were concerns from members that this was not a good time from what they were seeing in the market and the coming of a likely recession, and they're interested in what the advisors feel as to being why this is a good time to invest. The advisors noted that timing the market is not really possible, but that said, stocks have dropped 20%, so this is a better time than previously. They pointed out that the funds are not providing any significant returns today, that the returns are not keeping up with inflation, and the purchasing powers of the funds is deteriorating. They also noted that historically, the only investment that will outpace inflation is stocks. They're not proposing moving all funds or even most funds. They're proposing slowly moving the mix of investments to an 85-15 split, with 15% stocks to be invested in the S&P 500 index. It was agreed that Ms. Patrick would take this proposal back to the Finance Committee and the full board to get an updated sense of the board that the trustees can then use as they're putting together their investments. So one of the things I asked them specifically is, was there some eureka moment that you're like, oh, now's the time that we have to do it because of A, B, or C? And they said, no, there's nothing like that. It's simply market's down 20%. It makes sense to move into it. I did take a look at when they first asked about this and wanted to move this direction. The market was, this was the 19th when I got my first note from Mr. Maxwell. The market was at 31,288. Then I pulled the information on September 30th. The market was 28,725. So the market had dropped 8% from when they first suggested doing it until September 30th. And I did that for cutoff, for quarter end cutoff. Ran it again today. Today, the market's at 36.25. So it's still down 500-600 points, but it's back up from where it was at the low point on September 30th, which just indicates that there's a lot of fluctuation. So when the Finance Committee had last talked and the board had last talked about this, the sense of the board and the sense of the Finance Committee was we wanted to stay conservative. I also told Mr. Maxwell that based upon board authorizations, there was $190,000 that might be needed in the funds immediately for special education teachers. There's $90,000 that might be needed in the trust funds immediately for regular ed, and there's $75,000 that might be needed in the trust funds immediately on the energy utility funds. So that comes out to $270,000, about $355,000. Since Mr. Ambrose has said he doesn't expect to need to tap into those trust funds. That's the status of where we are now, present. And so what they're asking us is, what is our sense of what do we think we should do in terms of investments? Now, just for clarity for anybody watching, the trustees make the decision. They're simply asking us for our sense of what we feel, so that can be one of the factors that they take into account in making the decision. So that's what I'd like to get a sense here, and then we talk at the school board meeting, we can further have that discussion with the rest of the board. Anybody want to kick it off?
I think I think the reasoning was really good. In fact, it makes a lot of sense in thinking about historically, I suppose, kind of hindsight. I mean, I feel like in the past it probably should have been done, and I agree with the whole it outpaces inflation. I mean, inflation outpaces what we've been making on a return. But you know, the timing being difficult that we might need to use the funds, but I guess if we're only talking about 15% and Mr. Ambrose doesn't really see that we're at that point, I guess it makes sense to me. I'm glad they explained that. I didn't look at that at first, so.
Your thoughts?
I mean, there's risks either way, right? There's risks today, there's risks tomorrow. There's agreement probably should have been done a while ago. You know, if you're going to get in, now's the time. There's stuff is slow, you know what I mean? So you can probably get a good, you know, 8% isn't the time. You still have that fluidity, right? For the needs of the district based upon the short term inflation and stuff later in this meeting. But, yeah, I
mean, my concern is I still expect that we're going to see a significant recession with further significant downturn in stock. And that downturn in stock will then, it'll come back up. I mean, stocks, they're always cyclical, and then the arc moves forward in time. I'm just concerned that we will have a situation where we not only have to get some return to counter inflation, but we're going to have to dig back out of the hole from the decline that's going to come from the recession. So my big concern is just the impact of the recession in the stock market. And I don't think that's factored in yet. Others would say it is. I mean, one thing that's for sure, and all the professionals tell you that it's a fool's errand to try to time the market.
Yeah. And when was their timeline? Did they even have one?
Only that they are going to be making the decision fairly quickly.
After the election, possibly?
They didn't say. I did mention in the meeting, I didn't have that in the notes, that generally speaking, the markets respond favorably to split government, because then nobody can just run the table and do whatever the hell they want. And it's just, there's less change, and the markets don't like change. Mm-hmm. So we did have that discussion, but they didn't say we're going to time it around the election. That wasn't their comment, although we're getting to the point where it might just be
it's a month away. So
right.
I think you're going to have a good indicator of, you know, where we're headed. And if nobody has a crystal ball, I think it's going to be a good indication of what happens.
I do think that certainly 15% is not an aggressive program. So it's not going to make or break anything, and it might pad for a better return. My only concern is, again, 15% if it goes down, another 15 or 20. Matt, your thoughts?
Historically, municipalities in New Hampshire have been investing their funds very, very conservatively, and mostly in cash. And there was one that, and you had spoken about it, where you reached out to one of the towns that I'm familiar with, and the cash wasn't available at the time that they needed it. There was an example where I got a trust report from another school district, and they've invested in the market, and the funds that they put in are not available because they've lost money on their investments. So my concern is not having the funds available. However, if it's invested very conservatively would be my recommendation.
And the other aspect of that would be, what would we think is a reasonable liquidity statement to tell them that we believe that X amount could actually be tapped, and that has to be available. We can't leave us short on that if we have a short-term need. I would certainly think the $75,000 in the energy trust fund would at least be on the table for liquidity requirements. Mm-hmm. And maybe you hedge around that. Mm-hmm. Any thoughts as to what kind of a number we might want to provide?
I think they recommended 15% the overall pool.
Being in cash?
No, being in stocks, no, or in investments.
Yeah,
so 85% cash.
So I think what, based upon his email, what he's suggesting is, we're gonna put some part of the 85%, the lion's share of the 85%, into conservative, like treasury type instruments and bonds. And the only way you're protected by bonds with an increasing interest rate is you have to hold them to maturity. So short-term bonds held to maturity. And then what they want to know is, what would your recommendation be for just, you need to keep this much in cash? Because we need some liquidity pool that needs to be protected.
Oh, so really, so you're saying 85% wouldn't deal with them because it's putting it into bonds?
That's their plan, is to invest that in conservative fixed income investments. And what they talked about was short-term bonds. And I asked, what do you mean by short-term? They said six months to 2 years. But with bonds, you can't really be in a position with interest rates going up of selling your bonds before maturity, because you get slaughtered on the value of the bond in the marketplace. You have to hold them to maturity.
So my instinct with this whole thing is that we comb through all the positions. We comb through the ESSER grants, we comb through the special ed grants, and we talked about every possible way that we could fund everything. And what we came up with was that we had wisely put the 2 positions in ESSER 2 that we thought were coming out of ESSER 3. So we have money to cover in the regular budget and the grants any position that we added for this year without using the contingency funds today. But we're still at 2.9% for the rest of the year, which is really low compared to where we would like to be today as an estimate. So fuel prices kick, fuel prices kick, something happens. I just, the liquidity of these funds right now, with the volatility of everything that's going on in the world, is just something that I'm continually concerned about today. If you'd asked me last fall or a year ago, 2 years ago, I might have said, 1 year, 2 years out, we should be okay. But I'm just feeling a little anxious about, you know, I mean, an organization of our size should have about 3 to 4% available for emergencies and things. And every year we give back roughly $1 million or a little more than $1 million, which is about 3.25% of our budget. So we're doing just about right on what we should be doing. And then you have contingencies for real emergencies. Like, I only asked for permission to tap those funds for this year if we couldn't figure it out with the budget, right? We've been done, and I just need to give Matt props and everybody. We worked really hard to not do that. But we did also have a very productive hiring year. So normally when you lose veteran teachers, you hire teachers at a lower pay rate. So you have breakage. Our breakage came in almost at net zero. We had a really good recruit. So that means we had quality folks with experience apply to come here. And we hired people with experience so that we didn't save the money in the breakage that we normally would in a year. So I mean, if you're asking about the climate or the concerns, I don't really feel comfortable having that money tied up in the event that we can't. If we need to be able to access it, I would be nervous. So that's my opinion. Matt, you're the finance person. I'm just sharing. It's a dynamic situation right now, and I just want to keep all options on the table. And how much money would we really make by investing? I mean, we're talking like 3% on that money for the risk of not having it available. What is the return on investment and risk here? So
let's say that you could make in the market, the rates have gone up, mortgage rates are now in the 5s, I believe, so 7. So you're looking at, let's say you could somehow make 10%, and you've got somewhere in the neighborhood of 900, so I'll use $1 million to make the numbers easier, $1 million worth of trustees, and you have an opportunity to make 10%. So you got a total of all your trust money that you can make $100,000, but you're only putting 15% in the market, so you're making 15,000 on $1 million, or 1.5%. Plus, you're going to get some 2 or 3 points on the short-term bonds. So $1 million times, I'll say 2% to shade it off for 15% going elsewhere. you're gonna get 20,000 bucks on these. So you'll earn 20,000. Your risk is that if it comes time to tap into them, you don't have it. It's not available for you to tap in. You'd have to go to the banks and get a loan. And pay the money out, the interest on the loan until that would be cheaper than cashing in a bond that you didn't hold.
Okay. So to kind of quickly speak about getting a loan, we can't.
Why is that?
Because the bank won't lend us a tax anticipation loan or a grant anticipation loan because the statutes don't allow it. I tried to do that when COVID hit. And
We don't have a line of credits with the bank.
no, we don't have a line of credit with the bank, but we have a line of credit with our credit cards. So I could probably float some debt just initially. So my recommendation really would be on some of these funds, like the energy funds, any investments would have to be able to come due with, say, within 6 months, so that any maturity cycle would fall within a fiscal year in which you may need to have to withdraw funds. Okay, but then like the unanticipated educational expense account, that would be something that would be unusual. That would be something that we can't even like anticipate what that might be. Right? Those, I think you could probably have a longer maturity schedule or maturity date than what you would have for, say, the utilities. Okay, so I think it needs to be structured in such a way that we can tap into the funds more easily for those items that we know are at risk the most.
So what you're suggesting is that there's a maturity date on the bond of before June 30th.
Yeah,
So that we can access the money if we needed to.
correct.
I can live with that. I just can't live with locking it up past June 30th. That's what's causing me anxiety. That's my recommendation. I know that, and I want to be clear that for the folks on the camera, I understand that $20,000 is a lot of money, but the risk return against a $37 million budget or $36 million budget is, I'm not sure that's
Yeah,
what.
I mean, my gut is still where it was previously, that I believe there's a recession coming, the market's gonna go down.
Yeah.
Again, I understand that it's a fool's errand to try to time the market, but I think we'd be better served if we're gonna make a move later in the year when we have better visibility on this year and where the economy is.
Or even July 1st, and then have it be a 6-month bond from July 1st for like 85%, because then it would come due before the following year, so that if we need the funds in the future, because these funds carry from year to year.
So let me try to summarize what I think I'm hearing. You two think that the 15% makes sense, and you guys are saying that, and on the fixed investment, you can't have a maturity date that exceeds June 30th because you might need those funds still within the year. Is that a fair assessment of?
Yeah, as of today, we covered it. As of today, we covered it. But it's tight, and we're being cautious.
Yeah, I think I just want to say that, to be fair, like, I guess I was speaking more of like what I would do, right?
Yeah.
This isn't my money. So I guess maybe I shouldn't say it, because like, I think, I don't know what Newton's looking at, but I think if my records, you may remember, with Chris being selecting now, but I think they're looking at 17% increase this year.
I'm not sure.
Yeah, I'll check the notes. It's in the notes. It's in one of the meetings. So they're looking at a 17% increase. For budget.
Oh, okay.
For their town budget. So, like if we do run into a situation where we have to start tapping reserves and stuff, like, I think we should have money around. If it was me, I'd go aggressive, but this isn't my money.
I mean, my inclination again would be that I would stay kind of where we are, and they're already putting money in to some of these fixed securities, rolling fixed investments.
And it's not, to be clear, it's not our decision, right?
Correct, it's not our decision. We can only say this is a sense of the board, and then that will be one of the things that they take into consideration when they're making the decision.
And have we had a clear conversation with them with where we are in the budget process this year?
We have told them that the the prior sense of the board is protect principal at all costs. And we told them that the budget is tight enough that we had to authorize $300-something thousand of spending against these trusts, and they might come due, and we might have to use those in this fiscal year.
And they're gonna have that money available if we need it, is what we're saying. Because if it's not available.
They're aware of those comments and those needs.
Okay,
What they're asking now is, can you please reconfirm what you think we need to have in cash? So it's clearly in my mind, they're moving towards making these investments. And so if we want to temper that willingness, then I think that we should say as a board, we want as the primary objective to preserve principle and to allow flexibility on liquidity, because we just don't know what we don't know yet, and we fear a recession coming and budget issues with inflation.
Matt, I would agree with that. You, you're the finance guy.
Yeah.
I agree with that. I have to say, of all the years that I've worked in public education, I'm the most nervous this year. I truly am.
Does that make sense from your perspective?
Yeah, I still like the 15%.
Yeah, I'm not
I
as worried
kind
about
of
the
agree with what
15%.
Rick's saying, like, it's not my money. The 15%, I don't think we should. I don't see us needing all of it. The treasury bond, tying it up for 6 months to 2 years, yeah, that doesn't really make sense to me.
I feel like I'm walking, and again, this is my first year on board, right? I feel like I'm walking into a situation that I've walked into before. You know, the district has been in a trim the fat phase, right? And trimmed a lot of fat, a lot of money is going back to the towns. If we saved $4 million, right?
Almost $4 million a year.
The middle school, and like once you start trimming off all the extra fat, then you start cutting the meat, and we're getting into that zone. And like I don't think now is the time to invest. I would say pause, maybe at least till the end of the school year, to see how we navigate through this, see how inflation goes up or down. Because I think everybody agrees we don't want to tap into reserves.
Right. Yeah.
I think we should have to fund the
Yeah, just know that this is not the funds that we have on hand. This is funds that are held by the trustees.
I get it.
Okay.
But they're asking for our recommendation, right?
Yes.
You know, I think you have to weigh in. I think they need a very clear picture of where we are in the budget process so far, and, you know, and make a decision.
So we will have to recommend something to the full board. So I'm still hearing now maybe we shouldn't invest in the 15%, but you're still okay with investing in 15%. Right?
So the whole board, we have to bring it to the whole board, and the whole board's gonna send this recommendation?
Yes. Yeah. And the board's going to be looking for the finance committee to say, well, what do you guys think? You guys have talked about this long.
And
Yeah.
I guess it's, sorry, go ahead.
no, if I'm asked, my answer is going to be keep it liquid. It's tight. We've done a really good job of not tapping these things, and we don't want to tap them. And I think we're going to be okay, and we'll work to be okay. But until July 1st, I'm not telling you we're okay. Right? I just don't feel comfortable.
I can come to that. I'm still fine 15% being in stock and keeping 85% liquid, but I could agree that the biggest factor is it should be liquid. So if I have to choose, I would say, okay, yeah, fine, keep it liquid.
So then it's fair to say then that our recommendation to the board would be that we want to preserve principle. We want to keep as much funds as possible in a liquid state to be tapped if needed, as we're getting very tight in an inflationary period with the recession looming, and that we can revisit this in 2023 still in the school year.
I think one of the things that's important to be really transparent about in this process is that part of why we were able to balance the budget for the position to not tap these funds is because we have unfilled other positions that we can't get staff for. If there's a recession, people will work more in schools because they're stable. Schools do better in a recession with hiring. We don't do well with appropriation. So it's very complicated in schools because of public funds and passing contracts gets harder in a recession. Working, if you look at 2008, they didn't pass a contract for 4 years or 5 years during the recession. So I think that it's important to recognize that if we do go into a recession, we might fill some of the positions that have been open, which we do truly need. But we can't get people to fill them. So we're doing okay, but it's not easy. Is that accurate?
We're okay with that? So I'm gonna say that we want to preserve the principles, so we would not be interested at this time in making the investment in the S&P 500. We need to maintain flexibility to get the cash. Can't have it locked up in investments that exceed June 30th. And we can revisit again later in the school year in 2023. Okay? Thank you. Matt, I think you've got the business administrator comments. 20 minutes? Oh, yeah, thank you. Have you ever read the minutes from the 7th? Did I get a motion on those?
Motion to approve.
Second.
Any discussion? All in favor? Aye. It's unanimous. Thank you, Matt.
Okay, so the first thing I want to share about my business administrator report is that we switched suppliers on October 7th, and we're paying 20 cents less per gallon. And we're going to be locked in at this rate for 2 years. Now, we're also trying to obtain electricity rates. The rates were actually thrown on my desk this morning, so I'm going to be calling the finance chair to discuss the rates. But the two lowest rates are 12 cents per kilowatt hour, and the next highest one is 13 cents per kilowatt hour. Okay.
Versus 7.5 today.
Well, we were paying 7.1 right now, and that's good until November. Okay.
The quote is good till November.
November what?
It's mixed depending upon the meter. Okay, so one would go like November 12th all the way up through like November 30th. Okay, so this is going to be just like a switch over to either the same vendor or a new vendor. And it looks like we may be going to a new vendor. Okay, the next thing is I also want to let the committee know about inflation. Inflation currently is at 7.4%, and I gave you a link to the state of New Hampshire report, which I'm putting up on the screen. It's now changed since I last did it. It's 7.2%. Here, I can make it bigger. Okay. Now I'd like to hear your thoughts about the inflation factor, because I'm building the budget right now. I really would like to hear whether I should be budgeting more in line with historical inflation or projecting an elevated inflation factor. Personally, I don't have a crystal ball. I've been kind of thinking about more of a historical inflation factor than what we're facing right now.
Historical, I mean, the last 40 years.
Yeah, usually historical is like between 2 and 2.25.
You want some dice?
That's,
And roll some?
you know, and that's the way it was for the heating oil. You know, last year when I did the heating oil, it was $2.19 when we built the budget, and I put in $3. Okay, we set aside some funds, but it was we still have about $3 set aside. It came in at $377.9, so it's a 72% increase. So yeah, this is rolling the dice.
The realities of inflation, I would tend to agree with going traditionally. Because when you look at you got a certain amount of inflation built into the contracts. The contracts are representing thumbnails, 75 becomes at 80, but somewhere in that area of the total cost.
Teacher.
Yeah, well, teachers, paraprofessionals, all the different contracts. So a lot of it's locked into whatever those rates are. So whatever those rates are, you build the budget on the majority of the budget on those rates. Then you have left over, if it's 80%, just to do my numbers well, I think we have a $37 million budget. If it's 80%, then you get $7.4 million left over that would be subject to some type of inflation over and above that. So the $7.4 million, you know, $2 million of it is tied to the bond schedule. So it's only $5.4 million that's really going to be tied to some type of an elevated inflation level. And I think that whatever that grouping of stuff is that make up that 5.4 million, I think you're gonna have to, I think the bulk of it would probably be historic, but you're probably gonna have to get a little less than historic on things like energy.
Yeah.
That's how I would see breaking it down anyways in my thought process.
Okay, I do want to also share that with like health insurance, I am expecting our experience rate to go up, where I've been seeing people starting to go back to the doctors.
Yeah.
I'm starting to see prices climbing. Okay. Last year the rate came in at I think 7.8% over the prior year. So I'm a little nervous with the health insurance.
But historically, that number, other than the recollection serves 1 year, with the exception of 1 year where we brought it down to 6.9%, I think you were holding for the prior, I don't know, 5, 6 years, a 10% number on health insurance. And then any overages there were then used for line item transfer budget adjustments out of the health insurance into something else came up. Or obviously if you need it in health insurance, you use it in health insurance. But that's what I'm saying. When I break down those different pieces, that's how I do it. But the majority of it, the health insurance would be included in 80%. So that clearly is something over and above just what the rates are in your salary contracts. The salaries are based upon the rates. And then I would go the historic on the others. And then if there's specifics like energy that you just know is not going to be at a historic level, then address those specifically to those lines. And then you should be able to tell us as part of the budget committee and as part of the school board, this is where bulk of it was this, these other line items apply here for these reasons. And that's very transparent to the community as to what you're doing. And it will obviously make sense to the community because it'll be, well, oh yeah, that's valid. But that's it. I see my electricity rates. I see my oil rates or what have you. And I think that will go a long way towards helping people understand how it's built.
And for energy rates, I don't see them declining really in the next 18 months much, unless the world has like a big kumbaya moment. I don't really see the energy market losing.
I would tend to think there's a limited amount that you can still pour into the market from the strategic reserves, so that tap is going to end up being turned off after the election. That will be pressure up on it. There doesn't seem to be any let up in what's going on in Ukraine and Russia, so that will be continued leverage up. They're cutting back production in OPEC, that's announced, that's going to be leverage up. So I tend to agree with you. I don't think that's turning around by 2024.
Yeah,
I think, and some of it's structural, it's just not refining anymore. We're not going to build it.
Yeah.
So I think it makes sense to treat energy a bit differently and apply something specific to energy.
Okay.
And I would not use historical. I agree with Jamie. You get down to that 5.4 million or whatever that number is, right? You contract your contracts, that's fine. But I would go more aggressive in that 5.4 million. And when you get more specific to energy, I think, I don't know if we're looking at that 7.2% and using that as a factor. I've said it before, I don't see how the numbers that I'm seeing in my industry are 7.4 is very underestimated. So, and energy is way more than 7.4% right now. So I don't think you go and you take 7.4 and you put the whole budget because it's only 20%. It's 7% to the 5.4. And if you need to bump up the energy because it's more than 7.4, but I don't know what else is in there of that 5.4 that's not energy. Those are still going up 7%. And I would argue they're going up more than 7%. So I would, grand scheme of things, you're not inflating everything. It's just 5.4 million. But I would go on a higher number. That's my opinion.
Because you're saying you're probably seeing anywhere between 12 and
I'm seeing up to 40%. I'm seeing most manufacturers 40%. Since the beginning of COVID, I'm seeing a 40% increase.
Yeah.
And you know, even they say at the grocery store, this has gone up, you know, and I'm like, no, I think it's gone up way more than that. That coconut milk I used to get was $2.99, now it's $4.39. That's not 7.4%. So I don't trust that number, but I would agree that we could safely put that in, except in the energy, I think it should be more, but I don't see how you're gonna get anything for, you know, I still think that 7.4 is probably not enough, but I'm okay with it.
Good.
Yeah, I'm not.
Yeah. Okay. So, you know, just in terms of when you're preparing the budget, so we've got monies in the budget now, right? So we had a lot of money that was a one-time spend last year. We had 1.1 million, 1.2, almost 25,000 less. 1.2 million went back to taxpayers. We had 537,000 that was withheld. So if you're on the one up and the other down, you get 1.7 million that we didn't use of the 36 million. And then we had $250,000 for the auditorium, roughly 120,000 for the track. We had 90 for the office, even though we had spent 90, we withheld 90 in the books. So that's 375 for almost 500,000 there. It should not be recurring. So that gets you to 2.2 million. And then we rolled over 1.1 million in encumbrances. Now half of that's probably these other things that's rolling over, but half of it is we're going to get the benefit this year of the spending from last year. So we should have monies that leave us less tight than we otherwise think that we would be
For this year.
But I
Going
guess
into
to
next
clarify,
year's
I'm not
budget.
saying go and take that 5.4 million, whatever that is, and just put a blanket 7%. I'm just saying line item by line item. And if something from last year we don't need this year, it's gonna go down. So I'm not saying it should necessarily go up 7.4% on top of 5.4 million. I'm just, if you're going through line item by line item, I'm just saying those ones I think would be 7.4%. But if it's not in the budget, you know, if we did a office last year, then obviously it's not gonna go in this year. I wouldn't do that plus 7.4%.
Yeah, I think I don't want to leave the impression that we're leaving the budget dry and there's not a nickel at the end of the year.
Oh, yeah, no.
So, I mean, we can identify on a $36 million budget that ended June 30th, that there's somewhere in the neighborhood of 2.2 to 2.7 million that was over and above needs that are going to be coming in 2023.
I don't agree with that completely, but I agree with your logic. So the piece that I would share just as a counterpoint, Jamie, is that the unfilled positions has saved us tremendous money. And those unfilled positions, a lot of them got filled in November or December of last year when the board voted to combine each of the two para positions to make a teacher for the intervention program. So a good chunk of that money was in the vast number of paras and teachers that we had for the intervention program that didn't get filled. Those got filled. So now the program is running. So it's important to recognize that there was, throughout COVID, a number of positions that were in the budget that didn't get filled or used, and those are now filled and working. And a lot of what they've been doing is keeping the schools open, which is going to show in the academic data that there's still a lot of concerns on that side.
I would recognize that delta between the 2.2 million that went back in 2021 and 1.1 million that went back in 2022. Oh, that's where a lot of that went.
Thank you. I misunderstood. Now I agree. I'm sorry. I thought you were 1.1, 1.2 is what we're shooting for, 3 to 4%. But I think that I'm not going to sugarcoat this. This budget is going to be very, very challenging. We've been working on it nonstop for the last 2 weeks, and it is not willing to say anything yet because I need to. I have never fine-tooth-combed at this level where we are literally looking at every single position and checking every insurance allocation, making sure that the budgeted amount is exactly. it is, the 7% is about a $2.5 million increase. And we have 3 contracts that have already been passed, so those mandatorily go forward. So that's about $700,000. I'm anticipating $300,000 or $400,000 in special ed. There's costs for special ed are through the roof, transportation, oil. This isn't going to be fun. I'm not going to sugarcoat it. It's going to be really, really, really hard.
Well, and it'll be important to be able to look at the line item when we get to that.
I agree with that completely, but I just wanted to give everybody a clear picture that if I just filled the requests that people are making and didn't do the editing that Matt and I are working on and really pushing the team to go dollar for dollar, dime for dime, 7% is conservative. It's bad.
See, and I can't logically understand that when you have so much of the money tied up in contracts that are nowhere near 7%.
No, I understand that, but you have to remember that if you look at the 7%, let's just say that the contract vote was for, let's say that we voted on the contract based on the number of employees at the step and rate that they were at the year that we voted on. That was 2 years ago. So some people would have gotten a 2 or 3% raise based on that contract. But we've lost almost 100 people in that time. And the people that we've hired are at or above the level that they were at, then the steps don't correlate to the amount of the increase that was negotiated. They correlate to the amount of the increase for the step that the person is at when they're hired. So you can't say that the contract, if it's 80% of the budget, it's 80% of the budget. If everybody stayed in the exact position that they were in at the rate that they were at the year that we negotiated, then from year to year, it would move forward just like you're thinking. That doesn't happen. We had 50 people we hired just this summer. So they're all in different steps and locations. So the percentage of the contract increase varies widely. It's wild. And so one person might have gotten 2% in a position and another person gets 17% because we hired a different person 2 years later for that same position that's at a different rate and pay scale.
Yeah, so as I said, then that'll be
the devil's in the details. I'm agreeing with you on that.
And so we'll have to lock down very tight. What was the 2021 actuals? What are the 2022 actuals? And also what is the 2022 budget and the 2023 budget and the 2024 budget? So we can lay those line items out.
And they need to be completely transparent to the community. I could not agree more, because it's going to be really tough.
Yeah. And
we need to just continue to do what we've done since I've gotten here, is be fair and honest. Truly, there's nothing to hide. We'll tell anyone anything they want to know. But the fact is that this situation is going to be, as Rick said, we're getting to the point where if we reduce any more staff, we're cutting into the meat. We are. I've reduced over 30 people since I started working. There's a point where it's a diminishing. Troy needs 3 teachers next year. That's $240,000 with benefits. He needs them. He has students coming to school in those grade levels. Now, we're going to talk about Memorial and whether or not we can move a teacher, or, we're still whittling that down. But I'm just saying that Troy needs 3 teachers based on enrollments. There's no question.
Regular or special ed?
Regular.
Okay, so that's different than what we were told in June.
Oh, yeah, totally. Yeah.
So we've had 40 new kids join that we didn't know about.
Troy keeps getting enrollments. He just got one yesterday. He just keeps getting kids. He's got 105 in first, moving to second, and currently second only has 80 students.
Yeah, so we'll close need to get with the enrollment numbers too.
Yeah. Oh, that's the beginning of everything.
Significantly higher than what we talked about in June.
It is. It is. Things are dynamic. It's a school. It's so hard to capture a year in advance what it's going to look like a year later. One time when I was a principal, I had an entire class move into first grade in July. An entire class, 18 students. It was a nightmare.
Yeah, and the sign up for those classes are July. Okay, so in June we can kind of gauge where we think we're going, but we really know at this time of the year where we're going to be going based upon the enrollment.
Well, unless we have what happened this last year, which is a bunch of kids enrolled right before school started. So it's not. The first thing that we do is we take the enrollments for the district.
10-1 enrollments,
What's that?
the 10-1 enrollments that we're.
We take
basing
the 10-1 enrollments, but then we look at also the real enrollments. So we try to keep track as we go, because it could be that at the end of June, a bunch of kids move out of first grade and we don't need a teacher inside. I mean, it's dynamic right up till the last minute. It's crazy. There was one year, a few years ago, where I reduced a teacher in kindergarten because we didn't have enough kids. And that's the group that's in second grade now. There's 80 students. So it doesn't always go one way, right? It's a dynamic thing. And we track the enrollments. The kindergarten enrollments are the hardest part because you never really know, right? We anticipated 90 and we ended up with more. And one year we ended up with way less. So it's tough because some parents send their kids to kindergarten in a private school and then they send them to first grade. So when I was a principal, I got a lot more in first grade in that community. We don't get that as much here. We usually know for kindergarten. And then there's always the parents that don't register until a week before kindergarten. I can't make them register. There's no mechanism or law for me to say, oh, you didn't register by July 1st or before we did the budget, so you can't come to school. It's tough.
Yeah, I found this, because I said this earlier, I just wanted to try to clarify. August 29th, the Kingston Board of Selectmen public notes, meeting minutes. It's actually references as much as a 15% increase.
And the challenge that we're gonna have, if they're looking at that kind of an increase, just when people get their December, for the people at home, I think everybody hears everywhere. When people get their December taxes, based upon what they voted for, not anything other than what they voted for, well, school and town, a $300,000 house in Newton is going to be an increase of $792. In Kingston, $675. Kingston's lower; they have a higher property tax base, so it's not as impactful. On a $400,000 house, it actually breaks $1,000 in Newton, $1,055. In Kingston, $900. So there's a significant tax increase coming. There's a recession coming. I mean, it's going to be tight all the way around. So it'll be important. I don't think we need to belabor it. It'll be important to get into the details and really understand.
Being as transparent as possible is going to be critical during this.
Yeah.
Yeah, I'll just want to say, they also said, and this is Chairman Wilson, encourage the departments to shine, to show that they are in service to the town residents and not the other way around. So basically, make sure you tell people what you're doing for, because the increase is real. Right? I paraphrase that part, but that's what it said.
Yep.
Yeah.
So to think that this budget is not going to go up is just, it's insane.
Right, but in my mind, I think it's going to go up 7%. It's insane too.
No, I said initially.
Yeah,
But I'm not saying that. Again, I want to be very clear. What I'm saying is that if we didn't comb through things tightly and really be even more careful than we've ever been, just the cold number is high. We're going to do a lot of work to get it, but I'm setting reasonable expectations. This is serious. That's all I'm saying. Don't know what it will be yet, and I promise you'll be the first to know.
Well, we'll get it on the second, right? But the joint meetings on the second. All right, so let's move on. I'm going to jump around and hit some things that we need to hit. Do you have any budget adjustments, Matt?
I do not.
Okay, good.
I think I want to jump in and talk about the custodial service contract.
Yeah, just before we do that, Tom, we talked about the ESSER funds in that general discussion. So just to reiterate, from the use of ESSER funds and other monies, your assessment right now is the authorizations to spend down the trusts for the special education and the regular education are no longer foreseen at this time.
We need to keep the option on the table, but we're not planning to spend it this time.
Okay, so Matt, why don't you step us through the custodial contract as the next item?
So in that vein too, we're trying to absorb some of the costs this year. So right now, I have 3 custodians positions that are unfilled. Okay, the estimated salary for those positions is $310,000. We're going to enter into we already have. We entered into a 90-day contract. I'm going to try to go out to bid for the remainder of the year. And I'm estimating that a whole year's worth of service is $210,000. So I'm hoping to try to absorb some of the losses from the heating oil through just hiring contractors. Okay, that means by doing that, some of my considerations are by doing a contractor, we're really reducing the quality of our service. Because normally the custodians do like a personal service for the teachers and make sure, we're gonna make sure the buildings are clean, okay? I communicated with all the committee members, and I wanted to share what Rick put down in some of his questions, and then what some of the answers were. I just want to make sure that what we're working on is just nighttime staff, so the contracted staff won't be there during the day. Any contracted staff that we're gonna, I'm sorry, any staff that we're gonna have on board are gonna be only during the day, okay? And then as people leave the service of us, we're gonna hire a contractor and replace them. At some point, we're gonna have a staff member on at night overseeing them, and that's kind of our worst case scenario for the remainder of the year. And then we're gonna revisit it before year end to see if this is something we want to do long term.
Let me, I think I've read, and then I talked to you about it. Right now, you have a shortage. You have an immediate need that needs to be filled, and you're looking at using contractor service to fill it, so you found a contractor to do that. Then you're also going to be looking at getting, I think you have up there, 3 contractors or bids from other contractors to say, if this is gonna be long-term, it's out to bid and people are gonna put in the bid for that. Right now, you're filling the immediate hole.
Yes, exactly.
That's what we're
That's a
asking,
fair statement.
and that's the way I put it to Matt. We understand that we need to get 3 bids for a policy for any long-standing item that but we've got an immediate need to literally clean the schools today. So we're saying, can we move forward temporarily and then go out to bid and do this because it's today? I have a question too, but that's the question to you. It's like, can we temporarily?
And that's why I wanted to stress that, because in my mind, you can't go this route and say this is what we're gonna do as a long-term strategy without getting different.
Absolutely, we know that, yep.
And I just wanted to make that clear. If it's something that we need to do short-term, and then we have some time fence around which, I think I saw something 3 months or something, maybe I misread that. But there should be a time fence that says this is, we will determine where we're going from this temporary position, and then if we're gonna continue this direction, we're gonna get quotes on. I just want to make sure that we're fulfilling the policy, getting the quotes.
Yes.
I signed a contract for 90 days, 3 months.
That's what
Right.
I
I told Matt that I could live with 90 days, but we needed more after that.
After that, we're going to go out to bid for the remainder of this year. Okay. And then we're going to evaluate their service and then determine whether we want to go out for a long-term contract after that.
Well, we'd go out for bids and then award a long-term contract.
Yeah, exactly.
Because it's hard to evaluate 3 different companies when one's working in-house already. We have to be careful to be fair and impartial.
Well, yeah, but really we're looking at this for the remainder of the year as kind of like a test to see if this is the direction we want to move in to begin with. You know? And if it works, then it works.
I'm a little lost, I apologize. Okay, so just run through the 3-month contract that starts today, or this month?
I think it started at the beginning of the month.
Okay.
Okay.
So over the course of the next 3 months, what are you gonna do?
We're gonna go out to bid for the remainder of the year. So that contract would, whoever gets awarded to would end on June 30th.
Okay.
Okay. And then, in the springtime, we're gonna evaluate whether this is a service we want to go forward with. Because the company that we have, in-house right now does Manchester, Bedford, and I think Londonderry. Okay. So those school districts have gone to contracted services already. This is kind of like put our foot in the water, test it.
And that 310 number includes insurance?
I was gonna add, that was my next
Yes.
question.
Yeah.
So we're paying custodians $100,000 a piece?
Yeah.
That's what that looks
That-
like. If you
that
divide
is-
that by 3.
That is, that's all in their salaries, benefits, including health insurance. New Hampshire retirement is up to like 24,000 a year per employee. And then workers' comp, they're at the highest rate. They're at 4%, where everyone else is less than a 0.5%.
Just seemed like, I mean,
It does,
it caused me to go, whoa.
I'm just running the numbers in my head, and I'm saying that means an average salary of somewhere around $60,000 to $65,000 on a salary basis. That seems high. we had said before that, in the last meeting, that all benefits in are about 52% or 51%. You had highlighted that.
Well, that's for the teacher, right?
Oh, I can share.
I thought that was you guys.
Yeah, it'd just be good for transparency. Again,
Absolutely.
I'm starting right out with,
I thought it was all, but
Oh, custodians get the same benefit package?
healthcare to do.
Oh, really?
Yeah. And that's what
Well,
they
when
do
I
is-
made, and I guess though, when I made that comment, that was total. It was a whole sum together of
Yeah, right.
of all of, when I made that comment, it wasn't compartmentalized.
Right.
It was,
okay.
I don't know.
All that I'm trying to do is to demonstrate the transparency that we're gonna need to get through the next couple of years. We need to say, I'm not comfortable saying it's $310,000. I'm comfortable saying it's this in salaries, this in, break it down. We need to do that for everybody. I've spent 6
That'd be
years of my
helpful.
life building up trust
Mhm.
with this community and these taxpayers, and I'm not gonna burn it down over a recession.
Well, and I think you're gonna be in the midst of it in March.
Yeah.
And people are gonna be looking, particularly after seeing December, so we have to have cards on the table.
We do.
And everybody's
And
gonna
I
see
need
it.
the three of you to really dig into the numbers and be prepared to tell us, this is what we're okay with, this is what we're not okay with, because the board has to help us truly sell where it's at with facts. This can't be the Tom and Matt show. It's gotta be everybody
Oh, I
is
agree.
totally involved. And we have to come to consensus about what we're going to do, and we're here to help everybody figure it out, right? It's a community issue and we need to support our community. I also need to be aware that the toll of the last 3 years on our students is sincerely concerning in terms of learning. And a lot of the intervention program that we've had has gone to covering classes to keep school open. That's been the intervention. Even in September of this year, I'm doing lunch duty and before and after school duty if they can keep the place running. I'm fine with that, but it's an all hands on deck situation still with staffing. And that is affecting the academics. But we'll talk more and we'll have really good conversations, but it's good to have them publicly and as transparent as possible, because there may be some tough pills to swallow and people need to understand what they are.
Correct. No one's gonna buy a pig in a poke in March. So it's gonna have to be, these are the reasons why, here's the information, and it's gotta be understandable, and they gotta be able to follow logic. And I think that's the only way that we're gonna get the community on board with the needs, is because they recognize it as a need.
I would be curious to see, you know, what we think in 3 months of what this outside custodial service is. Because my immediate thought is, geez, if we can save that much money, we're talking about a tight budget, do we want to continue this? But the flip side could be facilities committee comes back and says our buildings are falling apart. So I want, comment of like, how much personal stuff are they doing? Flip side to that could be, is that what's keeping our teachers here? Is that keeping the teachers happy that they're getting, like, so I'll be interested to see what, after 90 days, or realistically, if we go through the end of the school year, what is said about this job? Because if we're looking for money next year, I wonder if this is where it's gonna be found, or some of it.
Well, that's what certainly we're looking at.
Yeah,
Cost benefit analysis.
Yeah.
Exactly.
You have to do it here because it impacts teachers.
yeah.
That's.
Well, right, because, I would hate for the teachers to be like, they're not showing, like, I feel like, in particular with this building, we really prided ourselves on how well it's been maintained. So if stuff starts to fall, like, is that something you start losing?
That's what you just spoke my mind, is that this
Yeah.
building is over 16 years old and it looks fantastic.
Yeah, so
I do not want that.
I'm
to
curious
change.
what the outcome will be.
Right. So the cost benefit is really important.
Key performance indicators in the
Yeah.
RFP, you have to be very
Right.
specific with those.
That, and also, I think we need a hybrid approach where we have some staff on hand
Yeah.
that are, doing our best interest.
Yeah, you have tenured staff here that very much care about this building.
Exactly.
And other than.
And what we've talked about is that if we do contracted services, that it would be more the night crew and the day crew is in ours. So it might be a hybrid. That we look
And
at.
because like something too to be said about the relationships, they're not just cleaning. The relationships, I've seen it with my kids,
Oh, yeah.
that they have with these, there's a real connection that.
You can't replace Mr. Riley and his vibe with the temp service.
Yeah.
You can't.
I will say that though, I mean, to be fair, we use one in our building, our corporate office, and it's the same contract that's been there, and for the same employee that's been in our building, is considered one of our employees. So
Yeah.
You can still build those relationships
Right.
if you get to that point.
And we have it with food services. Kara's a part of our team. And our bus company, as long as they can get people, but it does shift the burden of coverage from us to them.
It sounds like we have enough time to do that cost.
Okay, so it's 4:30, let's call a wrap, and we'll pick up, I think we did get to the questions again, so we'll get those. I mean, you guys have seen the questions and the answers, and concerns or issues, just,
Yeah.
you know. try to
You're thorough.
So, we're all set.
Okay,
Yeah.
we're all set.